Hi there. I welcome you to this very interesting presentation on sensitivity of a business. This sensitivity is extremely important for businessmen because it gives them the information as to what is the margin of safety uh, for the business in various areas, mainly investments, revenue, costs, and the cash flows. So let's proceed. May I request you to please subscribe to my channel, like, and comment. Thank you. So, the sensitivity concept is explained taking an example. The data that we got here is for 3 years. That means year zero when the investment is made, and then following year and second year. The initial investment is $6,500, and all these figures are in thousands. So please bear that in mind. And the expenses for the year one are $2,500, and expenses for the year two are 2,500, and the revenue for year one is 7,000, and the revenue for year two is 7,000, and the net cash flow for year one is 4,500, and the net cash flow for year two is 4,500, adding up to 9,000 for 2 years. To start our presentation, I first calculate the present value of the net cash flow. The rate of interest I have taken is 9%, that is the discounting factor, and the net cash flow for year one, 4,500, is multiplied by the present value factor 0.91743 to give us the present value of 4,128.44. And for the second year, the net cash flow is 4,500, and it's multiplied by the present value factor 0.84168 to give us the present value 3,787.56, and the present value for year one and year two adds up to 7,916. So now the net present value, as abbreviated NPV, is calculated. We take the investment $6,500, and we deduct the present value calculated in the previous slide, and that gives us the NPV $1,416. So now the first calculation is that of the increase in investment, and we got this figure here, $1,416. That is divided by $6,500 to give us the figure 21.78%, and that is the possible increase in investment and the margin of safety for NPV to be zero. So 21.78% is the possible margin of safety for investment to increase. So now the present value of revenue less present value of expense will have to fall to $6,500 for net present value to be zero. So you know very well that $6,500 was the investment in the project, and the cash flows and their present values can fall up to $6,500 $6,500. So that is the margin of safety. Now we calculate the net cash flow percentage by dividing net cash flow by revenue. So $4,500 is divided by $7,000 to give us 64%, and that is the net cash flow percentage to revenue. And now we consider as to what is the required annual cash flow for the investment of $6,500 and using the present value factors at 9% discounting factor. And we divide $6,500 by the total of the present value factors, that is 1.7591, to give us $3,695, and that is the required annual cash flow based on the discounting factor of 9% and using the investment figure of $6,500. So now we deduct the required annual cash flow figure from the actual cash flow, that is $4,500 minus $3,695 to give us the figure $805. So the net cash flow may decline by $805 each year, and that is the margin of safety. Now there's the calculation of the decline in revenue. We got the formula there, and we pick up the figures from the previous slide. $805 times 100 divided by 64, and that gives us the figure $1,257. So that is the decline in revenue and the margin of safety. So now we calculate the decline in units, and we divide $1,257 by $10, that is the unit sale price, to give us the figure 125.7 units. So that is the margin of safety for decline in units sold. So now we got this calculation of admissible percentage decline in sales volume, and we divide 125.7 by 700 times 100 gives us the figure 17.97%, and that is the admissible percentage decline in sales volume. And this calculation shows the admissible reduction in selling price. We got $7,000 minus $805 to give us $6,195, and we divide this figure of $6,195 by 700 units to give us the unit price $8.85, and we deduct this from $10, that is the actual selling price, to give us the answer $1.15, and we take a percentage, and the percentage is 11.5%, that is the admissible reduction in sale price. Finally, we consider the admissible increase in expenses. So expenses can increase by $804 or $1.14 per unit. So this represents 31.9% increase, and revised increase in expenses is 4.71. So the permissible increase in expenses is $1.14 per unit. Well, I hope that you got a hang of the concept of sensitivity analysis. Basically, it provides the margin of safety in various areas which are relevant to projects and other investments. And we have considered the possible increase in investment, the possible decline in cash flows, selling price computation, and also the possible increase in cost. All these calculations are important for businessmen to know as to how much things may go adverse to the business and they could still be at break even. So that is the idea. And thank you very much. And I look forward to giving you some more interesting presentations. Until then, bye for now.